Are you approaching retirement or already enjoying it, only to find that taxes feel different? Many assume taxes simplify once paychecks stop, but for a surprising number of retirees, the opposite is true. Taxes don't just fade away. They transform into a powerful lever for your financial well-being, demanding a new level of attention and strategic planning. This isn't about paying more, but about understanding how to keep more of what you've earned, making your retirement truly yours. If you watch this full video, you'll gain a profound understanding of why taxes often become more critical after retirement, even when your overall income might be lower. This isn't about complex loopholes. It's about empowering you with knowledge to make calmer, more informed financial decisions. We aim to provide decision support, guide you toward tax optimization, and solidify your retirement preparation through smart financial planning. This video is specifically designed for pre-retirees eager to build a robust, tax-efficient retirement plan, retirees seeking clarity and control over their current tax situation, financial planners looking for deeper insights to better serve their clients, tax advisors aiming to reinforce the strategic importance of post-retirement tax planning. This video will not offer quick fixes or predict future tax law changes. Instead, it will illuminate the fundamental shifts in how taxes interact with your retirement income, helping you understand the why behind strategic tax planning. Our goal is to empower you with practical knowledge, reassuring you that with awareness, you can navigate this landscape confidently. Before retirement, taxes often operate on autopilot. Your employer withholds taxes from your paycheck, and for many, the system feels predictable and largely out of their direct control. You receive a W-2, file your return, and that's often the extent of your engagement. This automatic process means you're primarily focused on tax preparation, ensuring compliance with annual filings. The heavy lifting of tax management is often handled by your employer, making it a passive experience. You might adjust your W-4, but the core mechanism remains largely hands-off. After retirement, this dynamic fundamentally shifts. The steady, single stream of income often gives way to a mosaic of diverse income sources. This transition moves taxes from a passive deduction to an active, strategic component of your financial planning. Withholding becomes optional for many income streams, placing the onus of tax management squarely on your shoulders. This newfound control, while empowering, also demands a deeper understanding of how each income source is treated. The timing of when you access your funds also gains immense importance, influencing your overall tax burden in ways you never considered before. This shift transforms taxes from something that simply happens to you into a powerful tool you must actively manage. It's a move from tax preparation to proactive tax planning, where every decision can have a ripple effect on your financial future. Understanding this fundamental change is the first step toward mastering your retirement finances. In retirement, your income streams typically diversify significantly, creating a complex but manageable tax landscape. Unlike a single paycheck, you might be drawing from several different buckets, each with its own unique tax rules. This complexity isn't a burden, it's an opportunity for strategic optimization. Social Security benefits, a cornerstone of many retirement plans. Social Security benefits can become taxable depending on your provisional income. This includes half of your Social Security benefits plus all other taxable income, including tax-exempt interest. Understanding this threshold is crucial for managing your overall tax liability. Traditional retirement accounts, 401(k)s, IRAs. Distributions from these pre-tax accounts are generally taxed as ordinary income. As you begin taking withdrawals, especially required minimum distributions, RMDs, at age 73, these amounts can significantly impact your taxable income and potentially push you into higher tax brackets. Strategic planning around these withdrawals is paramount. Roth accounts, Roth IRAs, Roth 401(k)s. These accounts offer the incredible advantage of tax-free withdrawals in retirement, provided certain conditions are met. They are invaluable for creating a diversified tax portfolio, offering a source of income that won't increase your provisional income or trigger higher taxes on other sources. Maximizing their use is a key tax optimization strategy. Investment income. This category includes dividends, interest, and capital gains from non-retirement investment accounts. Dividends can be qualified, taxed at lower capital gains rates, or non-qualified, taxed as ordinary income. Interest income is generally taxed as ordinary income. Capital gains from selling appreciated assets are taxed at either short-term, ordinary income rates, or long-term, preferential rates, capital gains rates, depending on the holding period. Pensions. If you're fortunate enough to have a pension, these payments are typically taxed as ordinary income. Understanding how they integrate with your other income sources is vital for accurate tax projections. Each of these income sources interacts with the others, creating a dynamic tax environment. This doesn't mean taxes become overwhelming. It means coordination and a holistic view are essential. Small decisions about when and how you draw income from each bucket can have outsized effects on your overall tax bill. For financial planners and tax advisors, this multi-source environment presents a rich field for value creation through integrated planning. One of the most profound shifts in retirement tax planning is the increased importance of timing. It's not just about how much income you have, but when you choose to take it. This strategic sequencing can dramatically alter your tax outcomes, even for individuals with identical total income. This is where true tax optimization comes into play. Consider the impact on your Social Security benefits. The amount of your benefits that becomes taxable is directly tied to your provisional income. By strategically managing withdrawals from taxable accounts, you can potentially keep your provisional income below certain thresholds, thereby reducing the taxable portion of your Social Security. This proactive management can save you thousands over your retirement. Required minimum distributions, RMDs, from traditional IRAs and 401(k)s, which typically begin at age 73, are another critical timing consideration. These mandatory withdrawals can significantly increase your taxable income, potentially pushing you into higher tax brackets. Understanding how RMDs will affect your future tax picture allows you to plan proactively, perhaps by executing Roth conversions in earlier, lower-income years. Roth conversions are a prime example of timing's power. By converting pre-tax IRA funds to a Roth IRA during years when you anticipate lower income, e.g., early retirement before Social Security or RMDs begin, you pay taxes on the converted amount at your current, potentially lower, marginal rate. This foresight locks in tax-free income for the rest of your life, shielding future growth from taxation and reducing future RMDs. Tax loss harvesting is another timing-sensitive strategy. By selling investments at a loss to offset capital gains and a limited amount of ordinary income, you can reduce your current tax liability. The timing of these sales, especially towards year-end, can be crucial for maximizing their benefit. This proactive approach to managing your investment portfolio can yield significant tax savings. Two people with the exact same total income can experience vastly different tax outcomes simply because of how and when they choose to access their funds. This highlights why taxes matter more as a planning consideration in retirement. It's about leveraging the flexibility you now have to optimize your tax position, rather than passively accepting whatever tax bill arrives. This strategic timing is a cornerstone of effective retirement financial planning. Many retirees and pre-retirees find themselves surprised by the complexities of retirement taxes, often because their expectations don't align with the new reality. The transition from a predictable, employer-managed tax environment to a self-directed, multifaceted one can be jarring. This isn't a failure of personal planning. It's a structural change that requires a new mindset. The primary reason for this surprise is the ingrained expectation of simplicity. For decades, taxes were largely a function of a single W-2 income. The idea that retirement, with its perceived reduction in income and work responsibilities, would introduce more tax complexity seems counterintuitive. This expectation of simplicity often leads to a lack of proactive engagement with tax planning. Another common pitfall is focusing solely on annual income totals. While your overall income might decrease, the composition of that income changes dramatically. A lower total income doesn't automatically mean a lower tax burden if that income is poorly managed across different tax buckets. The interaction between various income sources, how one withdrawal affects the taxability of another, is frequently underestimated. For instance, Taking a large distribution from a traditional IRA might not only be taxed as ordinary income, but could also push more of your Social Security benefits into the taxable realm. These cascading effects are often overlooked when individuals focus only on the immediate tax implications of a single transaction. The interconnectedness of retirement income streams is a critical, yet often surprising, aspect of post-retirement tax planning. This isn't a planning failure in the sense of making a mistake. It's a structural change in the financial landscape. Retirement replaces the predictability of a single income stream with a wealth of choices regarding when and how to access your assets. This newfound flexibility, while empowering, demands attention and informed decision-making. It requires a shift from simply preparing taxes to actively planning them. Understanding this expectation gap is the first step toward bridging it. By acknowledging that retirement taxes are inherently different and more strategic, you can approach them with the necessary mindset. This empowers you to move beyond surprise and into a realm of proactive, confident financial management, ensuring your retirement is as financially secure as possible. It's easy to feel overwhelmed by the perceived complexity of retirement taxes, but there's a calmer, more empowering way to approach them. Instead of viewing taxes as an unavoidable burden, consider them a fundamental part of your decision-making environment. They are not just a bill to be paid. They are a strategic lever that, when understood, can significantly enhance your financial well-being. You don't need to achieve perfect tax optimization to benefit. The goal isn't to eliminate taxes entirely, which is often unrealistic, but to cultivate awareness. Understanding how different income sources are taxed, how timing impacts your overall liability, and the flexibility you have in managing withdrawals empowers you. This awareness allows you to make deliberate choices that align with your financial goals, rather than reacting to unexpected tax bills. Think of it as having a financial GPS. You don't need to know every street name, but you need to understand the major routes and how traffic, taxes, might affect your journey. This knowledge helps you choose the most efficient path to your destination. For retirees, this means understanding how taxes interact with your income sources, such as Social Security, traditional IRAs, Roth accounts, and investment portfolios. It also means appreciating the power of timing. Deciding when to take distributions, when to execute Roth conversions, or when to realize capital gains can have a profound impact on your annual tax liability and your long-term financial health. This flexibility is a powerful tool for tax optimization, allowing you to manage your taxable income year by year. By embracing this perspective, you transform taxes from a source of stress into an area of strategic advantage. This understanding allows you to make calmer, more deliberate decisions about your retirement income, ensuring you keep more of your hard-earned money. It's about taking control, reducing surprises, and building a more resilient financial future. Let's return to the core idea that underpins our discussion. Why do taxes often matter more after you retire, even when your income might be lower? The answer lies in the fundamental transformation of your financial landscape. Retirement introduces a new level of complexity and opportunity that demands a strategic approach to taxes. You now understand that retirement fundamentally changes where your income comes from. Instead of a single W-2, you're likely drawing from a diverse portfolio of Social Security, traditional and Roth retirement accounts, and various investments. Each source has its own tax implications, and their interactions create a dynamic environment that requires careful management. You also grasp the critical importance of when income is taken. The timing of your withdrawals, distributions, and conversions can significantly impact your annual tax liability, influence the taxability of your Social Security benefits, and affect future required minimum distributions. This flexibility is a powerful tool for tax optimization, allowing you to proactively manage your tax burden. Finally, you recognize how these different income sources interact. A withdrawal from one account can have ripple effects on others, potentially pushing you into higher tax brackets or increasing the taxable portion of your Social Security. Understanding these interdependencies is key to holistic financial planning and avoiding unwelcome surprises. This newfound understanding doesn't eliminate taxes, but it dramatically reduces surprises and stress. It empowers you to move beyond passive tax preparation to active tax planning, making informed decisions that optimize your financial outcomes. This clarity helps you make better decisions over time, ensuring your retirement is not just comfortable, but also tax efficient and secure. Please like this video if you have enjoyed it. Every one of your likes truly encourages us to continue creating helpful content. Thank you for watching and have a blessed day.